All right, so now we're to Chapter 9, and Chapter 9 is reporting and analyzing liabilities, both short term and long term. Liability really has three components. It's something that um, ties you, or something that happened in the past, is non, it's something that happened in the past that you have to pay for and creates a future obligation. So a debt, what is a current liability? It's a debt. A liability means you owe somebody money or you owe them something, performance. In the case of unearned revenue. In the case of unearned revenue, again, you either have to perform to satisfy the liability. That may be building a fence, building a house, providing a product, um, or you have to give the money back. So current liability is a debt that you owe that is due within a year of the operating cycle. A lot of this is notes payable, accounts payable, unearned revenues, accrued liabilities such as taxes, salaries, wages, and interest. So, to be classified as a current liability, a debt must be expected to be paid within A or B, whichever is longer. Notes payable, written documentation of obligation, frequently issued to meet short-term financing needs, usually requires borrower to pay interest, and you can do it for whatever time period works for you. Here are accrued liabilities. This is going to be a lot of your current liabilities. And again, accrued liabilities are due to GAAP accounting. We record expenses that we incur, and the payment of these is a separate issue. Payroll for employees, every time an employee works that day, we've created a liability we owe them. We don't satisfy that liability until we pay them. Others are utilities, maintenance, rent, unearned revenue, accounts payable, federal taxes, state taxes, interest payments. These are all things that we have to pay. And if we incur them, we have to put them on our net income statement and balance sheet. So on September 1st, 2027, Cole Williams Company signs a $100,000 6% 4-month note maturing on January 1st with First National Bank. Now, one of the things you need to know how to do is to compute interest. And so I'm going to have a little second short video on computing interest and also amortization. Interest is calculated based on principal amount, which in this case is $100,000, interest rate, which is expressed as the yearly rate of 6%, and time. So in this case, the time is increments of a year since the interest rate is expressed as a year. So to determine the interest that we have to pay, first, again, when we record the liability, we received cash of 100,000, and so then we debited cash and credited notes payable. And the interest we're going to end up paying again is 100,000 times 6%, and this is for 4 months. So we're really looking at um, a third of a year. And so for the yearly rate, if we had this for a year, we would pay 100,000 times 6% times 1, because that's 12 months over 12 months equals 1. So it would be $6,000 for a year. But we're paying a third of the year. So really, we're paying a third of $6,000, or $2,000 is the interest payment. So here is the interest that we're going to pay. Again, 100,000 times 0.06 times 4/12, or 1/3, really. So we're going to pay the $100,000 back plus the interest. And so we're going to pay cash of 102,000. We have satisfied our liability, so we don't owe 100,000, and we've satisfied the interest amount. Sales taxes payable are just something that is due the government. Let me see if I have something. Okay, South Dakota versus Wayfair. On June 21st, 2018, the United States Supreme Court ruled 5-4 in South Dakota versus Wayfair. It basically said that um, now, normally, before Amazon came to Tennessee, you would not have had to pay sales taxes. But it's actually a sales and use tax. So a company prior to this, if they didn't have a nexus, in effect, they didn't have a building in your state, they didn't have to collect the sales tax. But you, as a consumer, were supposed to pay the use tax. In fact, I bought furniture from North Carolina, forgot to pay it, and the state of Tennessee sent me a letter saying that I owed them the use tax, which I promptly paid. But now they have decided that if you have more than 200,000 transactions or over 100,000 of in-state collections, you have to remit sales taxes to the states. Now, this has not been fully finalized, and they are working on it. But think about a small business. Of course, I guess if you sell $100,000 in the state, that's not real small. But a company that sells nationwide has to know the tax rate in every county and city of every state which they do business. Now, for instance, in Williamson County, you have to pay 9.75% for sales tax. And of course, this is the major source of revenue in Tennessee. But that consists of a 7% state rate and a 2.75% county rate. So other counties may charge less. I'm not sure what it is in Murfreesboro, but that is a different county, so they may not be 9.75. But as a company, you now have to determine what those sales taxes are. You now have to file sales tax reports with each state and then remit the dollars. So sales taxes isn't revenue, it's just recorded as a liability, but you've received the cash in advance and then you're supposed to send the cash back to the state. Again, unearned revenue just means you've received money. You've debited cash, you credit a liability, unearned revenue. When you actually perform the work, you're going to debit unearned revenue because you have fulfilled the liability and you would credit revenue. So examples, airlines, so when you buy a ticket for an airline, that's a liability to them until you actually fly. And then they can record it. Same thing with a hotel, unless, of course, it's non refundable. Current maturity. So if you have a mortgage is usually 15 or 30 years. If you're a company, you have to take all of the interest and all of the debt that you would pay for the next 12 months and move it from long term debt to short term debt. And again, why do we want to do that? Because it makes a difference whether you have to come up with a payment over the course of a year or whether you have to come up with a payment in 5 years. So here is cash is borrowed at $50,000. That's 50,000 times 12% times 6 months. All right. So in December, you'll have borrowed this for 4 months. So that's we come up at 50,000 times 0.12 times 4/12. So we would have to record that interest expense and an interest payable of $2,000 at the end of December. Payroll and payroll taxes payable. If you've worked, you know that if they're paying you $20 an hour, you're only going to collect part of that because you have to pay the government their share. You may have deductions for health insurance, or vision insurance, dental insurance. You might contribute to a 401k. So all of those are payroll deductions, and they're not necessarily immediately sent to the vendor, whether it be the government or whether it be an insurance company. So they'll keep those amounts until it's due the uh, entity. And at that time, they will relieve the liability because they've made the payment, so they no longer owe that amount. Payroll is very tricky, and you have to determine at the end of each month how much you owe your employees, how much you owe the government for FICA taxes, not only your part of the FICA taxes, but the company's part of the FICA taxes. Same thing with federal income tax. Of course, the place you work for doesn't owe federal income tax for you, they owe federal income tax for themselves. If there are any state or city income taxes, and we're blessed in Tennessee that we don't have a state income tax. And so you have to accrue all of this at the end of the month and figure out what do you owe your employees that you haven't paid them. And if you have 17,000 employees, you have to make estimates as far as, let's say, if I have part-time employees, how much are they going to work? If I have employees that are making overtime, then how much am I going to pay them? So it can be very complicated. Social Security. There's some misconceptions about Social Security. I just read an article today that the Social Security is going to go broke by 2023. And what does that mean? Well, it means that the surplus that has been building for years is going away, but Social Security won't go away because it's being funded by everybody working. So, what may happen is that there'll be either a reduction in the benefits of about 21%, or they'll have to increase the tax. And a lot of people go, well, that's, we don't want to do that. But think about this. We encourage you to set aside money for the 401k. Social Security is a payment for you in your retirement. And so you may not be real happy about if they increase it, but it's an investment in your future. It's an investment. You're investing in being able to have a payment at a certain a point in time. And don't you want to have a nice retirement? So how much you get is based on the 35 highest years of earning. Now, if you only work for 30 years, they still average 35 years, but you have 5 years of zeros. You have to earn a minimum of 40 credits, but you can earn a credit if you make $1,010, or let's see, $1,510 a quarter. And so after 40 credits, you qualify. So basically 10 years of where you're making at least 1510 each year. And that probably will increase over time. It replaces approximately 38% of your income, but if nothing changes in 2035, I have here, but I heard it's now 2033, then it's going to only replace 27%. So is it worth you to pay a little more so that it gets back up to the 38%? That's a personal decision. You can retire at 62 for reduced payments. Currently, 67 is what's called full retirement age. If you retire before that, they may not give you your full payment because you're making money. And then 70 is the max. You can so they basically said, okay, you're a male and you are expected to live a certain amount of time. We're going to look at your 35 highest years of earning, and we're going to come up with an amount. Now, the average is $1,800. I think the maximum you can get is over $5,000. So, depending upon how much you make, you're going to be somewhere in that range. So they're going to go, okay, I've got this lump sum that I expect to pay them. And so we'll give it to you. But if you take it early at 62, well, we're going to give you less each year. If you wait till 67, obviously we didn't pay you anything from 62 to 67, so your monthly payment is going to be higher. Now, if you wait till 70, obviously, you haven't tapped into this amount, and then we're going to pay you the rest over time. You don't get any advantage of waiting after 70. So really, it comes down to, well, how long do you think you're going to live? And if you're optimistic, then you're going to wait until 70 if you can financially, if you're still working and if you don't need it. I think 67 is probably the sweet spot because if you factor in the time value of money, then I think it really makes sense. Although a lot of people will, a lot of advisors will say, hey, you should wait until you're 70. Now, all of your Social Security isn't taxed and they don't take a FICA. So the most it can be taxed is 85%. So if you were to get $1,800, you're actually netting more than that because, again, you're not paying federal taxes on the whole amount and you don't get FICA taken out, which is 7.65%. Medicare, there are different parts of that. Again, it's similar. Medicare, I think that may go, the here may be broke even quicker than what the Social Security is. But Medicare, again, you automatically qualify at 65 for Part A. Um, Part B, you have to pay a monthly fee if you want Part B. Part B is for doctors, doctor visits, things like that. Um, Turn it to the Medicare and get a private plan, but that's a decision you'll have to make when you get to be 65. Employer payroll taxes do not include um, taxes, yes. All right, so a bond just means that we're going to borrow money from you, and normally it's for longer periods, and normally they're sold in $1,000 increments. So a company is borrowing money. The U.S. Treasury notes are supposed to be the safest investment in the world because it's backed by the U.S. government. Although with our $1 trillion deficits, I'm not sure how long that's going to last. But you buy a bond, you give a company $1,000, and they're going to pay you interest, and then at the end of a period of time, they're going to give you your $1,000 back. Or you can buy $10,000 or $20,000 in bonds. And the way it works is that the bond has an interest rate, and the present value of that bond, if it's 7%, let's say, is the cash flow. So if it's a 7% bond, normally you're going to get $70 a year, and it might be split into $35 twice a year, or even $17.50 four times a year. But you're going to discount that cash flow at 7%. So you have $70 a year for however many years, and then you get your $1,000 back. And so you're going to discount that at 7%. And that's really, how bonds work. But whenever you issue a bond, and it takes a while to issue a bond, the interest rate that you put down on your bond is not going to be the same interest rate when you actually issue the bonds. And so the bottom line is you're either going to end up, if you're the company, getting a premium or having to sell the bonds at a discount. And it has to do with the interest rate that is on the bond and the current interest rates. As a bondholder, you want the highest interest rate possible. And so what that means is that if you have a bond for 7%, but the market is paying 8%, then nobody's going to buy your bond. Why would they pay 7% when they can pay 8%? So what they'll do is they'll plug it in and go, okay, again, I'm going to look at this cash flow. I'm going to look at the $70 every year and then the $1,000 at the end of the term. And I'm going to discount that back to the current market rate. And so the current market rate is 8%, which is higher than your 7%. And so when you do that present value, it's going to be less than $1,000. So if the market rate, if your rate is lower than the market rate, then you're going to get a lower amount than the face value. And so you're going to have to sell this at a discount. The opposite is true is if you have 7% and the market's 6%. So you are paying more than the market. And so so you're paying higher, you should get higher. But it's going to be the same thing. And so at any point in time, the value of a bond is the cash flow payments discounted at the current rate over the term of the bond. And that's how they determine what a bond is worth. So, in summary, and we'll see some of the slides here, we have different types of bonds, but if your rate is lower than the market rate, you're going to get a lower amount than the face value. If your rate on your bond is higher than the market rate, you're going to get a higher amount, okay, called a premium. So, lower, you get lower, that's a discount. Your rate's higher, you'll get a higher amount, that's a premium. And there are different types of bonds. Unsecured bonds are called debenture bonds. That's what most companies will sell you. So there's nothing tied to, it's not like your a secured bond is a mortgage. So if you can't pay your mortgage, the company comes in and takes your house away from you. Convertible bonds mean you can convert to something, usually stock. Callable bonds, and why I haven't really invested a lot in bonds is that the company can issue a bond, but then they can call it. So let's say that they do have a higher rate, and then the market rate keeps going down, so their rate is really much higher. They can call and go, okay, I'm going to give you $1,000 now, thanks, but see you later. So you got a bond that because that cash flow was being discounted at a lower rate, your premium keeps going up for you, the bondholder, but then they call and go, sorry. So, you have to redeem the bond. Here's a bond certificate. Um, Again, bond prices are quoted as a percentage of the face value of the bond, usually $1,000. So if I quote 97, then that's 97% of 1,000. So obviously, this is a discount because we're not paying the full $1,000. Here's what I said. You just discount cash flow at the current market rate. Your cash flow is determined by the bond's interest. If the bond's paying 5%, then they're paying $50. If the bond's paying 10%, they're paying $100 each year plus the $1,000. And so you discount that cash flow. And you can look at those, but we're not really going to go into the accounting for these because it really is very complicated, and even experienced accountants have difficult with this. But you need to probably look at this slide just to kind of give you an idea. Again, your rate's 10%. So your rate is higher than the market rate, premium. You get more than $1,000. Your rate is lower than the market rate, you get a lower amount and a discount. But again, this is very complicated accounting, so I think we'll just wrap it up with that. But you do need to know how to calculate interest rates. That will be on the test, and you do need to know how to do an amortization schedule, which is something that I'll go over in a separate presentation.